Welcome everyone. I hope you're all having a great week. We're almost at Thanksgiving and I thought it's time for a portfolio update. What I'm actually doing with some of my money, what I'm doing with my portfolio, and my thoughts on some of my biggest holdings like Amazon, Netflix, Google, and Microsoft. Now, we're going to be going over all of these. I'll be sharing my quick thoughts on these companies and we'll just be doing a brush up on how I feel these holdings are doing. Now, I have to give a quick disclaimer. This portfolio here with the $140,000 I've put into it, this one is a secondary portfolio. My primary portfolio is called the Passive Income Portfolio. You can follow that one on a link in the description of this video. I have a whole nother channel. I follow that portfolio. It's much larger. It's almost at $400,000. That one I've been funding a lot more aggressively, and it has an entirely different style of investing. This one is very volatile, very risky. I would never have this one as my primary portfolio. It's just not, it's not conservative enough for me. I have one that's a dividend growth portfolio that's far more conservative, and it's actually been performing a little bit better than this one. So if you haven't already, go follow that one as well. But in this one, we look for world-class technology companies that I think will be able to outperform the market. Now, starting this in 2021, it has not gone well. We started this right at the peak of the market, the worst time possible. So I'm off to a very poor start, but I still have hope. In fact, I still have a strong belief that I'll be able to surpass the S&P 500. I know it seems like nonsense right now. I know it seems crazy, but we're really not down all that much. We're down maybe 20, 25%. When we look at a lot of these companies here, we compare the S&P 500 in red there to the Story Fund in blue. If I bump this up, you might be able to see it a little bit more clearly. The S&P 500 is basically flat. It fell quite a bit. The Story Fund fell more, but we're holding on to it. We're trailing along, and I think we can catch up. I think over the next 3 years, we really can catch up. The reason I say that is if you really look at the holdings page here and see how much I'm down on these companies, I'm down 26%. And a normal stock can trade anywhere from 30 to 50% in fluctuation in a single year. Peter Lynch always warned about how volatile stocks are, that they can trade way down and then they trade way up when people become bullish again. And these companies, these aren't garbage companies. Amazon is not a garbage company. Netflix is not. Google's not. Microsoft's not. Adobe, Apple. These are very good companies, very intelligent people working at them. And I think that they can turn this around. So let's start off with Amazon here. This is my top holding. My cost basis on Amazon is just over $50,000. So that's how much money I've put in the company. And it's currently down $18,800, which is 37%. So it's traded down around 40 to 50% this year. Amazon is a volatile company, but this is underperforming my expectations by quite a large degree. And to be honest, it's not really unwarranted. When I look at Amazon as a company and their actual fundamentals, it just hasn't been great. We look at the free cash flow is going way down for quarter after quarter, while expenses and employee expenses and stock-based comp is going up. We look at the earnings of the company, and the Rivian stake has hurt the earnings, making it look like they're losing a lot more money than they actually are. That hasn't been good for them. Same thing with the net income. The EBITDA took a dip, and it's not really recovered back to where it was in 2021. All the fundamentals are moving in the wrong direction if you're looking at the numbers. But Amazon has a lot of things going on. I am still very bullish on this company. The major properties of Amazon, which is their media business, Amazon Prime Video, I think is incredibly good. I think that's a very good property. The Amazon Prime subscription, I think, offers a ton of value and has a high lifetime value for its customers. The ads business, I think, is incredible. You don't have to worry about iOS. And the retail business, I think, is growing. Their actual revenue continues to grow every year. And I think that AWS will have continued strong growth. It might go through dips where it slows down a bit with the fears of the recession and lots of companies cutting back. But overall, these main drivers are going to continue to grow. And I think the people that can hold on to a company through volatility, through these dips and lows, are the type of people that will get the reward at the end. So what I look at in terms of the actual story of Amazon, the story of this company and my thesis on it, it hasn't materially changed enough. It hasn't changed enough for me to sell it. I'm still holding on to it. I think the biggest drivers of the company are still intact. I think the management needs to do a couple things to get the company back in order. Now, they are doing some things. We have a report from the Amazon CEO saying that they're eliminating job positions, and these aren't just warehouse jobs. These are in the headquarters. They're eliminating some some jobs to cut costs. Because there's some things like Amazon Alexa that are costing the company $10 billion a year in losses. $10 billion a year in just Alexa. They have a lot of places they could pull back a slight amount, not all the way. They still want to grow and do things, but just pull back a little bit and be able to bump up these numbers a lot, make the company a lot more profitable. So they're going to be doing job cuts, and I think that that's okay. They've been hiring like crazy, so cutting back on that I think will be helpful to the stock. The other thing is a new report, and this is something I thought was interesting from Amazon. Cinema stocks, so like Cinemark and AMC, jumped over a report that Amazon's $1 billion plus investment into theatrical releases. Amazon is going for like they're going for the Disney play. They're trying to become a major studio, not with just Amazon Prime Video, but in the movie theater. Listen to this report. Amazon plans to make 12 to 15 movies for theatrical release each year. 12 to 15 per year. They want more than a movie a month. That's pretty crazy. I didn't know Amazon's going to do this. I knew they had Amazon Prime, and they're going big into that. They're doing things like, the Rings of Power, right? There's lots of criticisms for it, but they're going big into different things in media. And this is another huge step. 12 to 15 movies. Now, if they have box office hits, that can bring in $1 billion plus a movie. So it depends on how successful they are. This is a hit and miss business. But 12 to 15, there's a chance every year they'll have a big hit, and that could bring in billions of dollars more for Amazon. And I really think this company has the studios, they have the content, they have the relationship with different studios to be able to pull this off. With Amazon, my thoughts, again, remain largely the same. I don't want the stock price to change my sentiment. And so even though the stock price is down, my sentiment remains unchanged. I think all the fundamentals are still there. I use the service every day. Everybody in my neighborhood uses the service every day. I think it's a very, very sticky product. I don't see people canceling Amazon Prime. So that one I'm hanging on to for a long period of time. I think I'll make money on it. And I said that before, say it again. I really think I'm going to end up making money on this company. We have the next one here, Netflix. This one has had a spectacular fall over the past year and a half. It was trading at like $550, $600, even got to $750, and then it fell all the way to $180 per share. Just went down like crazy, 70+%. Bill Ackman got in this stock, and then they had another bad quarter, and he sold out. He sold out because the company's unpredictable, is the words he kept using. In my opinion, I don't consider Netflix as unpredictable as Bill Ackman does. I think quarter by quarter it's a little unpredictable. I think it's highly volatile. So it's a volatile company. But Netflix really only lost less than 1% of their total subscriber base. That was the big problem with Netflix, losing less than 1% of their total subscriber base, which, by the way, they're now gaining back. So that's not too unpredictable in my opinion. Netflix, I think, is one of the most predictable companies long-term in the market. I've always considered this a company that has eventuality. It is almost inevitable in my opinion. I think that Netflix is an inevitable winner. It's free cash flow positive, already at scale as a large streaming player that can reinvest $17 billion plus a year into its content to maintain and grow its customer base. That's very predictable, very reliable. I think it's inevitable at this point. I just think it's a matter of time. And even though the stock is trading around, again, I'm not going to let a 37% hit on this company change my sentiment on the stock. When I look at Netflix, they're moving in the right direction already again. They are doing some things that are surprising to me. For example, I came across this report today. This is breaking news, basically. Netflix is hiring up to build high-profile PC video games. Now, I've known for a while that Netflix is going into gaming, but so far they've been little mobile apps, like little racing games and things that you play on the phone, right? They have this image of a girl on the phone playing there. Those aren't high-profile PC games. Those are little mobile games that are somewhat similar to like indie games. But this report here reads differently. Netflix video game ambitions may be taking a step up as the company's Los Angeles games office is looking to hire a skilled director to build, quote, a brand new AAA PC game. Brand new AAA PC game. Do you know what type of games are AAA? What that means? Here's the type of games that are AAA. Let's go ahead and look at some of these. God of War, The Witcher, Elden Ring, Doom, Flight Simulator from Microsoft, Destiny 2, Grand Theft Auto. These are AAA games. Fallout 4. AAA really means the highest echelon of games, the highest quality, the biggest production, the biggest value, right? The biggest amount of money invested in it. That's a AAA game. This is not something that I expected Netflix to do. I thought they'd continue on with their kind of social, smaller games that don't require as much capital. But this is a little bit of a shift, and right now I'm not sure even what I think about it. They say that's light on details, but suggests a high-profile computer title versus the casual mobile titles that Netflix has focused on so far. Netflix is looking for other roles on teams to work with a director who's ideally has experience in first-person and or third-person shooter games. We know other AAA games that have come out. Call of Duty, Warzone, right? Call of Duty 2. That's the big one right now that Activision just released. These are massive titles. When you get into the first-person shooter category, it's competitive. There's a lot of games. There's Valorant, there's Call of Duty, there's Counter-Strike. There's all these games that all these studios are making because those are the type of games that real PC gamers love to play. First-person shooters in particular are really in style right now. Those are the ones people love. They say as well as extensive experience working on live service games, which means online multiplayer. So what we're looking at here, and this isn't confirmed by Netflix, but this is a little bit of deductive reasoning. We see that they're hiring AAA game studios, looking at first-person experience and online multiplayer. Looks like they're going to be doing competitive games to maybe Call of Duty or Valorant or any of these first-person shooters, right? Maybe the Overwatch series. They can make a competitive one against that. So there's a lot of them to pick from. There's a lot of strategies they could take. They can make it look realistic like Call of Duty, or they could make it more cartoonish like Overwatch. We'll see what they do. They say in September, Netflix said it would launch an internal game studio in Finland. Again, my thoughts so far up until today was basically that Netflix was doing these more little social phone games, but I think Netflix is probably going to be more bold. If I know anything about the company, they are pretty bold. When they find something to go for, they just go for it. So it doesn't surprise me they're going for AAA games. I think a lot of people's reactions, a lot of investors' reactions are going to be negative on this. Just buy Microsoft if you're going to buy a game company, right? I think that'll be investors' reactions. In my opinion, I'm going to wait this one out before I give a very firm opinion on it. But I don't hate the idea of Netflix pushing in and creating maybe a AAA title. It'd be very interesting. And if they wrap it into their subscription, that could be even more interesting. You pay $10 a month for the Netflix library and the right to use this massive AAA game, and then they can just continue to layer on more value to it. So we'll see. We'll see what this does. I'm interested in this one. I personally think just the video aspect, the entertainment video aspect, is enough to push this company over the next 10 years. I think it will be highly profitable. Again, I think this is one that I'm going to be heavily in the green over the next 10 years, but we'll see. Right now, I'm proven wrong. I'm being proven wrong. I'm down 37%, which is $12,000. So we'll see what the future holds. Now, next up, we have Google, one of my favorite companies in the world. I really love this company because this company has changed my life a lot. YouTube is such an incredible thing. People can start businesses on it. I worked as a programmer full-time, going into the office, writing code, and that was a very enjoyable career. I really enjoyed doing that. But YouTube has been so interesting doing this as well. It's just been a very incredible thing to do. So I owe a level of gratitude to this company. I really like what they've done with YouTube. I love how they allow creators to create entire platforms on YouTube. And I think overall the business, even outside of YouTube, is phenomenal. Now, I came out with a video that many people thought was, well, not many people, but I got a couple messages on my Discord of people saying, wow, Joseph, you are critical with Google and their management. And I think that's fine. Just because there's a company that I'm invested in and that I'm bullish on and that I really have a lot of my money tied up in and that I'm grateful and thankful for as well, doesn't mean that I can't ever look at it and try to think of ways that it could improve. And the video on Google was basically me going over some places that I think are significantly lacking with this company. The explosive amounts of employees they're hiring, I think, is a problem with the company. Like the stock-based compensation it's just skyrocketing up over the past 5 years. And I think Google's aware of it. They're getting letters now from massive shareholders that have $7, $8 billion invested in the company, pointing that out. Google also spends and loses an enormous amount of money on other bets. And Google's sitting with $116 billion in cash, when their stock is trading at a 16 PE ratio. Like, come on, Google. Use some of your cash and buy the stock. You can generate more cash in the future. Google they can make back their cash, but they don't always have a time period where their stock's trading at a 16 PE. Trade that cash for stock and do it quickly. Do it before the stock races back up to a 25 PE. So those are things that I highlighted as ways that Google can improve. But I think there's a more important takeaway here. I highlighted many ways that Google is being mismanaged. Things that I think the management are lacking on. Their discipline in employee costs, their capital allocation strategy with not doing aggressive buybacks right now, different things that they can improve. And Google as a company's doing good even with those mistakes. They have such an amazing core product that they can make mistakes and they can still do well. Imagine if they correct those mistakes and they have their core product. That's more upside. So I look at this as a company that's doing well, even though it's not having a lot of discipline. If they exercise more discipline in their capital allocation and their management, I think it will just do extra well. So basically what I'm saying is I see a lot of upside in this company. With all the flaws of it right now, if they start correcting those, they maybe cut back on employees and costs, they start doing more aggressive buybacks. I really think this company, I think it should be trading at a 25 forward PE ratio. And I think that it will continue to grow earnings if they really pick up the buybacks. So this one I'm bullish on. Happy to have it as my third holding. I think it will outperform the S&P 500. Microsoft is next. This one I've been bullish on for so long. I have a lot of Microsoft. I own it both in the Story Fund and in the passive income portfolio, and I have around 30 to 40,000 of it in the passive income portfolio. Why do I own so much Microsoft? Because I believe this company today is worth $350 per share. I've been saying this repeatedly. A lot of people think I'm nuts when I say this. They highlight it and say, Joseph says that Microsoft is worth $350 and it's only trading at $250. So he's obviously wrong. I don't think I'm wrong in it. I think it's still worth $350. I think the company's undervalued right now. Microsoft is going through some temporary issues with their earnings, mostly because of foreign exchange issues. So the foreign exchange, the amount that they earn overseas because of the currency is worth less than it used to be. And that's the biggest problem with this company. Outside of that, they're growing their revenues like crazy. They're growing their cash flows like crazy. They have very good discipline with their growth. They're not growing stock-based compensation at a speed like Google or Meta has been. Just all around, I look at the fundamentals and I think this company is well managed, well insulated, massive moat, credit rating better than the US government. It has 80% of its revenue as recurring, and they're buying Activision Blizzard, which I think is a fantastic property for Microsoft to own. Look at the actual cash flows this company produces. Massive cash flows that's going to be added to Microsoft and make their value proposition of their Microsoft Xbox Pass all the better. I think the company's worth a lot more than it is today. Time will tell if I'm correct. A lot of people think I'm wrong on this one, but I'm going to continue to hold it. I don't see any reason to sell out of it now. Now, if we move on from Microsoft, there's a couple other companies that I don't have big updates on. The story's basically the same for Adobe, Salesforce, and Apple. Berkshire, I think, is just, I think this company's undervalued. I think that Buffett and the team there are incredible. In fact, I have a video planned on Berkshire, a deeper dive into this company, because I think people really underestimate it. I think this one's going to heavily outperform the S&P 500 on a risk-adjusted basis and in nominal terms over the next 10 years. And then the last one is Crocs. This one's up 35%. I'm up $700 on it. This one is not a company I'd ever pour tens of thousands of dollars in. Just not a big moat. It's kind of a meme company to some extent. But when I look at the fundamentals, I do think it's undervalued. It trades at an incredibly low PE ratio. It trades as though it's highly cyclical. And they bought the Hey Dude brand, which I think is a great brand for them to own. And I see a lot of growth drivers for this company. So between the extremely low valuation and them expanding their brand and diversifying, and what I see as a very popular shoe that I think has more staying power than people give it, I thought I would make a double on this company. I really think I can make a 100% return on it, maybe in a year or two, because again, this one's not a long-term compounder. I would not call this company a compounder. This is an undervalued company that I'm looking for rapid growth, multiple expansion with. So far, we have a little bit of that, but I'm going to try to wait until I get 80 to 100% gains on this one and then cash out. This one has never been a long-term holding since the very beginning. The rest of these ones are. Every other company in the portfolio our long-term holdings. So that's a quick update. That's the Story Fund. I'll continue to track it. We'll see if we can catch up to the S&P 500. If you want to follow my other portfolio where I have a lot more capital, I'll put a link in the pinned comment below. It's called The Joseph Carlson Show. That's it for now.